Look, to buy when there's blood in the streets. Lift up, check under the carpet. Many try, but few become master of the market.
David Wright, thanks very much for coming on Masters of the Market. Really looking forward to having a chat. I thought a good place for us to start would be with Zenith and what you guys do there.
Yeah, thanks, Chris. Good to be here. So Zenith, what do we do? I mean, our business model is really to try and identify the best fund managers in the market, both from an unlisted perspective, but increasingly listed, so LICs and LITs and exchange-traded managed funds, rate them and sell those research and ratings to financial advisors.
And what sort of families or businesses look to use your services?
Yeah, so it's from the very large sort of financial advice businesses, like your BT, Westpacs and the various financial planning businesses within that group, to your suburban accountant that does some financial planning for his clients as part of his business.
And there's a bit more nuance to it than just yearly performance. Talk us through some of the risk-adjusted things you guys look out for, maybe some of the things around correlation between different funds that businesses like to see from you guys.
Yeah, there's a lot more to it. You're right. Most people focus on performance. And of course, performance is important. That's what, at the end of the day, investors want. But performance can be generated in a lot of different ways. So, if you've got a really volatile fund or investment or manager, then you need to be compensated for that volatility with high performance. And that isn't always the case. So we're very focused on looking at how efficient the performance is generated. So if a manager is taking on a lot of additional risks as opposed to the share market risk, then you want to be rewarded for that return. The other thing we look at is consistency of returns, and how they generate their returns. So do they generate more of their returns when the market's rising, and do they outperform the market when the market's rising? And do they protect capital when share markets are falling? So that's sort of called a hit ratio, or a lot of people refer to it, particularly in the US, as a sort of batting ratio. So yeah, it's much more than performance, and risk adjusted, as you said, is a key to what we do and look for in the numbers.
And how do you get to know, if I'm a large family office and I've got positions in multiple funds, how do you give some detail and colour around which fund's going to be more highly correlated than the others?
Yeah, so sorry, I didn't answer that question. Correlation's hugely important when you're constructing a portfolio. You don't want all of your investments doing the same thing at the same time. I mean, it's in an ideal world, you want all your cannons firing all of the time.
Yeah.
The reality is that just doesn't happen with the different asset classes you're invested in. Different world markets perform differently at different times. So, in an ideal world, when you're constructing a portfolio, you want a portfolio that's going to generate attractive returns through different economic and market cycles. And in order to do that, you need to combine managers that have low correlation with each other. That might be, within Australian equities, using a manager that's got a value investment style with a growth style and maybe a long short. So style, correlation, really important to get that diversity when you're constructing a portfolio.
And in terms of funds that regularly have consistently shot the lights out, what are some of the characteristics of a high-performing fund?
It varies. So particularly in Australia, well, everywhere has finite markets, but the Australian market in the global context is reasonably small, as you know. So in a lot of the asset classes in Australia, there's what we call capacity constraints. So in general, you don't want to invest in a manager that has a lot of funds under management, because that just restricts their ability to generate returns over and above the index or the market in which they're investing. So that's definitely a key consideration.
You hear a lot of managers talk about how easy it was when they were managing $50 million or $100 million, and now that they're up, if it's a small cap manager managing $700 or $800 million, just how much harder it is to outperform the index. Are you surprised more micro cap, small cap managers don't look to distribute a chunk of cash back so they can keep going back to that smaller size and create the alpha that they started creating in their early time?
Yeah, that's pretty rare. I mean, you're
Because they're
very-
addicted to the fees.
Exactly. So, but you're right. Like many of the managers in micro cap, small cap, even mid cap space will close their fund
Yeah.
so that they protect the ability to generate, additional returns for the existing investors. As you say, it is pretty rare to see a manager return capital to investors.
Didn't
We've seen it-
Paradise do a big capital return years ago?
They did, and that really, that hit the media everywhere because it's really is pretty unheard of. But,
Yeah.
As you say, a great way of protecting the manager's ability to generate, additional returns for the underlying investors. So, that was something that we're pretty positive on, to be honest, and we're also positive on managers being true to their word. So, when you're investing in them early, if they say, look, if we're going to close the fund at 0.5%
Yeah.
of, the small ordinaries market cap, we want to see them do that.
Do you see it as a different skill set, those managers that are incredible at picking micro cap and small cap stocks? Is that transferable to mid and large cap stocks, or do you often see it as a different skill set?
There's a real difference between being a good stock picker and being a good portfolio manager.
Yeah.
So you see this a lot, and we've seen this historically where, respectfully, you've got brokers coming out of a stockbroking organisation set up a funds management business and, have picked individual stocks for their clients probably forever, but when they're constructing a portfolio, managing a portfolio on an ongoing basis, in general haven't been that good. So I would say, to answer your question, there is a different skill set between, small and micro cap investing and investing in Aussie equities large cap. You generally need to be is a lot more nimble and, usually the portfolio turnover is somewhat higher in particularly small cap as opposed to large cap.
In terms of that portfolio construction, is that a world that's dominated from what you see by the long short guys, or do you see some long only guys that are able to de-risk their portfolio by, whether it's the amount of cash they hold or gold or some other insurance type strategy? Or is it really a world where you see portfolio construction dominated by the long short crew?
Oh, look, I think the ability to protect is, you've got another lever with long short for sure. The majority of managers, long managers are, their mandate requires them to be fully invested. To be honest, we probably prefer that because you've seen a number of managers that have said, look, we've got a flexible mandate and we can go to, 50, 100% cash if we can't see value in the market. Single asset class managers are historically pretty poor at the asset allocation decision. So,
It's almost like the asset allocation decision to be made by the investor in the fund, where they can say, well, I'll hold some cash here for a rainy day. I don't need the fund holding it there on my behalf.
Exactly. So, and if you have a portfolio of managers that have really flexible mandates and able to go, up to 100% cash, that gives you no ability as an investor to manage your cash and your cash allocation on a look-through basis. So we do think that's a better approach for individual investors.
And in terms of some of the other qualitative things you might look for in a fund manager, particularly if you're trying to find a smaller one that's got the ability to outperform, is there a history of the founders working at bigger, more successful shops, or their ability to have skin in the game invested alongside you? What are some of those qualitative measures you would see that generally have a habit of correlating with good performance?
Yeah, I mean, as you say, there's nothing like skin in the game,
Yeah.
let's face it. So the managers managing their own money alongside that of investors, we definitely like to see that. As you say, we do like to see a track record. I think it's incredibly important that you're invested with people that have invested money through different investment market cycles. So, and that's pretty hard, right, in the sort of bond and fixed interest space at the moment. We've had a bull market for 20 years. So there is a lot of participants in the fixed income market that have never seen a bear market in bonds. So we do want to see people that, have a conviction in how they invest. They understand, where their competitive advantage is, and as I said, have the commitment through extreme market conditions to hold that conviction. Because what tends to happen with those that don't is, as soon as you capitulate, the market will turn around and favour the approach that you had. And we saw that through the sort of tech, media, telecom boom of, the late 90s, early 2000s. And you see it sort of time and time again, particularly with really stretched market environments. And, maybe one at the moment is, the big dispersion between, value and growth managers. So that's two different styles of investing, both in global equities and Australian equities. And growth managers have outperformed value for the longest period ever. You're sort of starting to get, some managers on the value side of things convincing themselves that actually this growth stock, is a value stock and it fits in my portfolio. So that's what we call sort of portfolio drift. And you don't want that, because as soon as the market flips over, they haven't participated in the ride up, and they won't participate when the market conditions change because they haven't remained true to label.
So there's a desire for human beings more broadly to be part of a group. And so you speak about growth investors or value investors, or, some funds class themselves as activist investors, which would be bloody hard work in Australia because you only have a few opportunities a year.
Yep.
Is there a place for someone to just be broad and open to whatever good investments they see fit that arise? Or particularly if you want institutional money, do you need to put yourself in a group so that it's clear around things like correlation with other funds and just what those institutions are investing in? Because if you give yourself too many rules as an investor, after a while they can sort of start to feel like a jail.
Oh, absolutely. Yeah, you want some sort of blend of what you're talking about. So you don't want, particularly in institutional, high net worth, sophisticated investors, generally won't invest in a go anywhere manager.
Yeah.
But at the same time, as you said, you don't want your portfolio constraints, your investment risks so constrained that you're not able to leverage the skill set of the underlying portfolio manager and investment team. So it is the case in institutional investing and the sort of space we work in, that managers do get, sort of labelled or pigeonholed. And when you're constructing a portfolio, you're looking at combining those managers of different labels in a sort of diversified sense. So, so there is that, but underneath that, you want managers with, reasonably flexible mandates to be able to do what they need to do to generate good returns.
So it's easy to see why funds or institutional investors have an advantage over private investors, just their access to resources, their knowledge base, their experience in the field. Do you think potentially that flexibility is an edge that a private investor can have over a fund, that when the market does turn, they can react to things quicker?
I do, yeah. I mean, it's with some of the institutional investors, they are so large, as you said, that, making an asset allocation change is like, turning around a massive boat. It's going to take a long time to make that happen because they got so much money. They can't liquidate holdings quickly. Whereas, for a individual investor, you've got much more flexibility and ability to do that. So even if it's not making a big asset allocation change, but you want to get out of one fund or LIC or LIT into another, generally you're going to be able to do that. So I do see that as being an advantage, because, one of the things with large institutional and high net worth investors is that they've got so much money to invest, they're almost too diversified. So what that tends to lead to is, an expensive sort of index result. Yeah. Whereas if you've got the ability to invest in, just 2, 3, no more than a handful of, flexible, high quality managers in each asset class, you've still got the ability to generate a really strong return and outperform the market.
And you mentioned index investing and passive investing, which has just been an absolute boom for, well, I think in the States we know over 50% of shares are owned by passive investing strategies.
Yep.
How do you feel about that? And I guess in a lot of ways it's in conflict with the very business you do, and some would even argue it's in conflict to capitalism, where money's meant to find its most efficient home.
Yeah, you're right. I mean, as a research house, as Zenith is, we fundamentally believe in the ability of active managers or quality active managers to outperform. That's not to say some asset classes are more difficult to outperform, more efficient, asset classes like, US large cap. There is sort of so much research of those companies that's a segment or market that's traditionally pretty difficult for active managers to outperform. The other extreme is, as you mentioned before, Australian small cap, Australian micro cap. The vast majority of active managers outperform the benchmark in those. So it's a little bit nuanced by the asset class, but look, you're right. There's been a massive trend, particularly in the States, and admittedly off a low base here, but some strong growth here into benchmark or passive funds. I think some of it's initially driven by fees. Obviously, you can get access to the S&P 500 for probably 4 basis points in the States, which is unbelievably cheap. But the other thing that happens that I don't think a lot of retail investors understand is that when you get really strong bull markets, frothy markets, where we've seen a lot of the mega tech stocks just become more and more expensive.
You're allocating capital just based on size.
Exactly.
As opposed to profitability or various other metrics that an active manager would be interested in.
That's right. So, as an active manager with a strong valuation discipline, you're not going to invest in those really expensive stocks. They just don't meet your criteria anymore. So it is quite normal in bull and frothy markets that, index funds are at the top of the performance tables. And so people see that and go, well, they're cheaper, they perform well, I'm going to invest there. And when you get a strong, which we've seen, as you said, in the States, really strong flow of money going there, that becomes a bit self-fulfilling.
Yeah.
That money's goes into the fund, it's got to be placed somewhere. Where does it go? It goes into the higher weighting stocks, or all of the stocks in the benchmark, obviously, but the higher weighting ones, and continues to push that price up. So it becomes a bit self-fulfilling.
And we've seen the effect it's had on, let's say, the large cap stocks out of the States, in particular the FANG stocks.
Yep.
Get spoken about a lot. We're yet to see passive investing decrease. Has there been a period where flows have come out of passive investing? I know decades ago it was off a much smaller base.
Yeah.
But we're yet to see what happens when those flows come out.
Exactly. So you're right. Like in previous sort of market phases and so forth, yes, we've seen money come out of passive, but as you said before, passive didn't own as much of the market as it does now. I think the same is true on the flip side. So, if we're starting to see it now, let's face it, some of the really expensive stocks where you get, an unknown catalyst like the coronavirus and so forth, sort of worrying markets, when you're sort of priced for, perfection plus, that's where the money's going to come out of. So, and that drives down, if that's a big weighting, which it is, in benchmark or index funds, that's going to hurt the performance of the index fund. And I think it's, increased market volatility, sidewards, downward drifting markets. That's where you'll really see, the quality active managers outperform.
Do you think the free brokerage that's happening in the States, giving more retail money access to stocks, do you think that's going to have an effect in volatility?
I do, because the thing that happens with retail investors is that, investing money is a very emotional experience. Nobody wants to lose money. Everybody wants to make money. And historically what happens with retail investors is they get in at the wrong time and they get out at the wrong time. So, which is interesting, isn't it? Like, if you think about, when the sales are on at the shops and so forth, people go to the shops and buy stuff. When the share market pulls back and stocks are cheaper, people take their money out They don't buy, and that's an opportunity to buy. So I think, as you said, like the flow of, and again, ownership of retail investment in markets. This is why you see, a lot of the Asian markets being, really volatile markets, because you've got a lot of retail ownership in there the investment decision is very emotionally driven. And to be a good investor, really, you've got to try and park that emotion and just see, well, if it was a good investment and a value investment at that level, it's got to be better, when the market falls.
And in Australia, we've had a recent Royal Commission into the banking and financial services sector to protect those retail investors. What changes have you seen in the industry post that Royal Commission, and what changes do you see coming down the pike?
Yeah, there's been some pretty big ones, let's face it. So, whilst the Royal Commission in the end didn't necessarily outlaw it, I think, the banks probably preempted that ownership of financial planning business and funds management business, sort of vertical integration as they were calling it, was not going to be allowed going forward. So, well, as I said, the Royal Commission didn't stamp that out in totality. The banks were a long way down the track of either selling their financial planning businesses or the funds management businesses, or both. No longer are you going to get so much money in those networks going to internal house product. And I think that's certainly better for independent, not aligned funds management groups. We've seen the increase of educational requirements for financial advisors and so forth, removal of, all sort of grandfathered commissions and that sort of stuff. That's leading to less financial advisors. And I think, those that survive through that process will be, are quality investment professionals. And that's what the industry needs, clearly, is, to be seen in the same light as accountants and the legal profession and other professional services, which I think is, where we're getting to.
And even you see a lot of super funds in Australia, tier one super funds, bringing their investment expertise back in-house. For years, they were sort of outsourcing a lot of it to independent portfolio managers or other funds.
Yep.
How do you think that plays out? Do you think that's a positive or a negative for those Aussies with super in those businesses?
Oh, look, it goes to what we were talking about before. So there's certainly, what you're saying is right. Like, a lot of the large super funds have been bringing in-house the capability, in particular, to manage, say, Australian equities.
Yeah.
So we talked before about, if you've got a lot of money and exposure to, a large number of investment managers, even if each of those investment managers is good in their own right, the combination of those managers is going to lead to, an index-like return, and probably at a higher fee. So, a lot of those large industry super funds have internalised that, and if they can generate with their internal return, index plus a bit, they're saving members a fortune.
Will they move to more passive investing, or are most of those super funds mostly going to be actively managed when they look at their Australian equities?
No, that's a good observation as well. You've got, groups like IFM, which is really a fund manager set up by the industry super funds, has a massive passive business. So parts of, the various industry super funds, equities and fixed interest exposure is passive, and done at pretty close to, zero cost. The flow and effect of that, as you're sort of alluding to before, is that, in the last sort of 12 or 18 months, you have seen the rationalisation or closure of, probably nearly 24 Aussie equity managers, both large, small, or large and small and mid-cap funds. So, we probably did have too many, but, that's pretty dramatic in a short space of time.
And talk to me about the fixed investment funds that are going around. What are the changes that's happening in that industry?
Bonds have had a 20-year rally. So there's been some outstanding returns generated from bond managers and bond funds. You've seen a lot of money flow to index or passive bond funds. and that's done well as well as bonds have continued to rally. It's a misunderstood asset class.
Bonds are.
Let's face it.
In Australia?
Definitely in Australia. To an extent, around the world at the retail level. A lot of people think of fixed interest as being, well, the capital is fixed and I'll get paid income. Unless you hold the bond to maturity, the capital is not fixed. It fluctuates with the market price. And yes, you do get paid the income. So a lot of the bond return in a rallying market has been through capital appreciation, as well as obviously getting the income. We've got to a point now, though, that bond yields are so low and bond prices so high that any move back upward, if we have inflation starting to emerge, there's potentially going to be sort of capital losses on bonds. That's an issue, and it's an issue for index funds where, without wanting to get too technical, the average maturity, or the duration as it's called, of those portfolios has lengthened a lot since the GFC. And it's lengthened a lot because both companies and governments have taken the opportunity to issue more bonds and longer dated bonds, because the interest they've got to pay is much lower than what it has been historically. So that's led to things like the Barclays Global Aggregate Bond Index, which is the index for global bond market. That's lengthened about 2 years. So and similarly here with the Bloomberg Composite Bond Index, lengthened about 1.5 years. So you're sort of looking at, say 5 years and 7 years for those two benchmarks. What that means is if you get a 1% increase here, you're going to lose 5% capital value. If you're in a global index fund, roughly that's 7%. So they've become very sensitive to changes in interest rates, particularly on the way up. On the way back up, that's a problem for investors.
And the bond market seems like a much better way to play the economy than the stock market, particularly in the short term. In the short term, the stock market is so heavily driven by liquidity. And you hear so many stock investors talking about the overall economic environment and expecting that to translate literally into stock prices. Do you think that's something that's often missed by Aussie retail investors?
Oh, absolutely. I mean, fixed income or bond managers are very focused on the economy and sort of macroeconomic events and so forth. And, look, historically we've been better predictors of that and economic activity than equity investors. And you've got that issue at the moment. Let's face it, we've had both bonds and share markets rally, which is real, and for an extended period of time, which is very, very unusual. It basically means somebody's wrong in that, bonds will rally where, bond investors are thinking there's not a risk of inflation emerging. Economic growth looks relatively subdued. Whereas the flip side's, true for equity investors, that, okay, things are great, like, companies are going to continue to generate great earnings because the economy's going well. So there's this big dispersion in, the two sides of the market in terms of what their view is going forward, and, not both can be right.
The arm wrestle having the bond market sort of telling you there's going to be no inflation for a long time. Is that the one thing in the markets, one of the things in the markets that no one's really prepared for, is what happens if inflation does come?
Very few are forecasting, absolutely. Yeah, that's right. So, which is interesting when you look at, say, the US economy's been going gangbusters. You've got close to, probably full employment there, and you haven't really had any wage growth. So
you've got ageing demographics, deflationary. You've got globalisation was deflationary. Technology, highly deflationary. But we've had significant inflation in things like asset prices. The share market, particularly with buybacks over there, has been inflated heavily. Healthcare over there is rising really quickly. It's the deflation's really been in wages and sort of man-made things, flat screen TVs or sort of consumable products.
Yep.
Some of those things are changing. Like globalisation, it feels like it might be changing and shifting and becoming more localised again.
Yep.
Demographics aren't changing. That's going to be deflationary in, certainly countries like the US and Japan and here, and even China's demographics don't look that crash on. More broadly, when you look at those arm wrestles, how do you sort of think about what's going to win?
Well, I think you've described well why we've had a bull market in bonds for 20 years.
Yeah.
Like you said, the sort of demographics, technology's been a big one. The average inflation rate, certainly now and going forward, appears as if it's going to be at a lower level than what it has been historically.
Is it a bit like backing a horse though? When you look at a horse race, you could say, well, this horse I think is going to win, but it's at $1.05. Versus this horse, I don't think it'll win, but it's probably a 10-to-1 shot and it's currently at 40-to-1. Is that the sort of bet that investors will look to make re-inflation, where it's not priced in to the market and in some ways it represents an asymmetric return profile?
Yeah, I think, and what you've described as well is what we're sort of seeing in funds management. So you can buy the market if you want, really cheap. And a lot of people have done that, as we discussed before. Or, look, I want to outperform the market. So I'm going to invest in managers that are truly active. It's the guys in the middle, like the sort of, around benchmark, but charging active returns. I mean, we think they're dead.
Yeah.
And you've seen that, in some of those managers we talked about before in Aussie equities that have closed, have been in that space. Index plus a bit, big funds under management, charging active fees. I think going forward, it's quite polarised. If you want the market, yep, you can buy it, it's cheap. If you want the ability to outperform the market and probably outperform it by, a good margin, you're going to get the sort of really active guys that, as you said before, are very focused on, managing their capacity. They're not just asset accumulators. Yes, sure, they've probably got a performance fee attached and they get rewarded for outperformance, but they're keeping a lid on how much they manage so that they can generate additional returns. So it doesn't really answer your question around inflation, but it does, I think, in some ways, is the characteristic of what's happened in a low inflation environment and the effect that that's had on investment markets.
It's the Margaret Thatcher saying that, don't stand in the middle of the road because you'll get run down from cars on both sides, isn't it?
Exactly, yeah, and I think that's very much playing out in the funds management trends.
So I like the saying, don't tell me about what you like, tell me about what's in the portfolio. What funds have you yourself invested your own money in?
Yeah, so obviously, well, perhaps not obviously, but as you'd hope, like we eat our own cooking. And as you say, there's a difference between speculating and investing. So we're investing, and that's a diversified portfolio. So, in the Aussie equities space, we like a combination of, long, large cap, Fidelity, long short, Ausbil, small cap, OC, mid cap, Pendle, and similarly through international equities, Magellan, MFS. We've got a manager there called, Ironbark Copper Rock, which is an emerging markets manager that is investing in smaller companies in emerging markets that, sort of like what you said before, are more localised. Part of the problem with a lot of the emerging markets stocks, the large ones, is that the index players are there. So if the view on emerging markets is negative, all the money comes out of those large liquid stocks. So you get more, talking about correlation, you get more correlation with developed markets. We don't want that. We want exposure to the true growth of emerging markets through these smaller companies. And then on the fixed income side, like we were talking about before, the fixed income or the bond markets are really very finely tuned at the moment. So, you need diversification through your managers in fixed income. So managers like PIMCO, they're a really good duration manager, truly active, done well, even when in the December quarter when bond yields increased. A local manager here, Ardea, that's sort of a relative value, opportunistic type manager in fixed income, which does well when market volatility rises. In the alternative space, GMO from a global macro perspective, Firetrail, Australian long-short market neutral manager. And then in, REITs or listed property, we like sort of Resolution, again, really active, Australian-based manager, but global. Done a terrific job.
And so there's a bit of an arm wrestle with funds management where you've got the LICs that often trade at a discount to net tangible assets. Don't know if you're Magellan, but most of them do. And then unlisted funds management businesses that trade at NTA. How do you see that playing out? On the one hand, the liquidity, particularly for retail investors, is great in the LICs, but it irks them that they can't get NTA valuations. How do you see that playing out?
Yeah, I think as we sort of discussed in the background, like if it's trading at an NTA and you're entering, discount to NTA and you're investing, does that really matter?
If you're coming in post-float and it already got a discount. Yeah,
it's a different issue if you come in, as you said, at float and then it's a discount.
Yeah.
But if it's a discount, does that really matter? It only matters to the extent that you obviously don't want that becoming a deeper discount.
Yeah.
So one of the things to look at there is the history of discount or premium to NTA. And you will see that, when you do that, you'll get an idea of what's the normal discount to NTA, and as long as the manager's performing, that'll be reflected in the NTA, and you buying in at that discounted price should be okay. One of the things that, you're right, a lot of money has been raised in LICs and LITs in recent times, and some of that has been in income or fixed income type securities that we don't believe retail investors fully understand. And so, again, this goes back to our comments before. Where that's the case, you get inefficient pricing of the LIC or LIT. So that's particularly and we haven't had it yet, let's face it, for a lot of these LICs and LITs, where you get a sort of stressed market environment, and maybe that's happening right now. The discount to NTA can become really large.
That's what Jeff Wilson's for, coming in,
exactly.
buying them up.
Yeah, well, that's right.
But that's an opportunity too, isn't it? If you see that discount, getting to sort of 30% or those sort of levels,
yeah,
it's a potential opportunity, isn't it?
It can be. Part of the issue, as I said, is people not understanding the underlying portfolios and securities. So, will that discount ever contract again?
Yeah.
It can be a very long time before that happens in some of those vehicles.
Are there many vehicles in play where retail investors can invest into a vehicle that then invest in wholesale opportunities?
Well, yeah. So again, really topical question. Magellan's, let's face it, been sort of a pioneer in a number of these spaces, and are now looking at having a structure whereby both the listed and unlisted are essentially one.
Okay.
So that's announced as recently as yesterday. If that's achievable, I think that that potentially revolutionises how people access fund managers. But you're right. There's a lot of query, I suppose, around some of the exposures that industry funds have. The direct assets, in particular, commercial property, direct infrastructure. Can retail investors get access to some of those asset classes? The answer is yes. Private equity is another. The answer is yes, but usually in a sort of modified form. So there are some sort of direct infrastructure funds, not many, but that have a listed component to it as well, or a cash element. So if people want to come and go within reason, they can. Similarly with private equity, there's a couple of funds that invest in like a partners group value fund, invests in sort of listed private equity vehicles, so you can get that exposure. You know, it longer term it performs like private equity. In the short term, you know, probably a little can trade a little away from the physical.
Now I want to finish with 3 questions, if you don't mind. What was your first investment?
Tax effective trees.
Oh, no.
Were all the rage. And needless to say,
How did that turn out?
that didn't go well.
I love it. I love it. I had a friend in Perth that invested in one of those tree plantation businesses, and he started going out with a girl whose old man was a really sophisticated investor,
Yeah.
and just was almost viscerally ill when he when he was told about this tree investor. So
You know, that's sorry to interrupt, but the shame about that is timber as an asset class, like is a legitimate asset class.
Yeah.
As you know, like in the States.
yeah,
But here, because of, you know, we wrapped all this tax effective and geared structure around it,
yeah,
it's gone away totally as an asset class because
Yeah.
so many people were burnt by it, which is a shame.
and what advice would you have, investment or otherwise, for your 18-year-old self?
Be patient.
Yeah,
So as we've seen before, you know, investing can be a really, most people get too emotional because it is money. They don't want to lose it in particular, and you know they obviously want to generate. But I think, especially in today's world, you've got so much information flow. The press sensationalise the movement in markets. You know, as I said before, most people get in. There's a fear of missing out on the way up. So you know, your neighbour's talking about your golf buddy at the footy club. You get in at the wrong time. And then when things start moving downward, you're thinking, I'm going to lose money here. You jump out and don't have the patience. So I think, you know, a massive competitive advantage is, as I said, trying not to be emotional about your investments, trying to sort of be logical. If you've got a good investment, you know, stay with it.
right. It's been brilliant. Thanks for coming on Master of the Market.
Thanks for having me, Chris.
Thanks, mate. Make sure you subscribe to Chris Judd Invest.
Many try but few become master of the market.